Let me ask you, when you take life insurance, are you protecting your wealth or you're protecting your income? Do you know the difference between liquidity versus financial protection or financial security? Let me dive into it. Let's take Martha, for example. Martha is a CEO of a multinational organization. She earns $2 million per month, and she has invested in assets. She has rental houses. She has bonds that give her bonuses every 6 months. She has shares that she enjoys a very good amount of dividend every year. For Martha, she looks at it and says that my assets are definitely worth more than 10 times my annual salary right now. If I was to pass away right now, my family would be fine. So when Martha says this, I asked her, that's a very good thing to have, and you've done well for your family. But if you pass away right now, how much liquidity will they have? Because look at it this way. Martha's salary of $2 million is what the family uses on a day-to-day basis. The bonds dividend bonuses is normally reinvested into the bonds. The dividend comes once a year. Rentals, if she combines the rentals together, they're giving her monthly amount of $700,000, which she then actually invests in another fixed investment vehicle. So what the family uses is this $2 million every month. So when that money is not there, the family remains with the assets, which, yes, it is worth more than 10 times the annual salary that Martha was earning. But in the event that that salary is not there, how soon will the family be able to access this money? The immediate one probably will be the rental, which gives them $700,000. They have been using $2 million every month. $700,000 does not cut it. The family is either going to be forced to liquidate these assets, either sell some of those bonds or sell some of those shares, or actually even sell one of the houses so that they have enough liquidity that they can then be able to use on a monthly basis. So when Martha looked at it and said, oh, actually that is right. My money, my net worth is tied up in fixed assets. And to protect that net worth, to protect those assets from being liquidated immediately in her passing because the family needs money, this is why she needs to take life insurance. So she calculated and said, fine, then I will take life insurance that ensures that they have liquidity that is ensuring that these assets that have accumulated are protected. So that was Martha. That is what liquidity does for somebody who has fixed assets. You may be worth more than 20 times your annual salary. But if your family is not able to access that amount of money in the event of your passing, because it is tied up in probate, it is tied up in fixed assets, it is not liquid, the first thing they will do is try and liquidate. In the next 6 months or 1 year, or God forbid that there is a court case, this wealthy family is going to be reduced to nothing because all the wealth that they've been left for is tied up in probate. What life insurance offers is that it ensures that your family gets that liquidity within 7 days of filing the papers. 7 days. If the liquidity is 10 million, 20 million, 30 million, 50 million, they get it within 7 days of filing. This liquidity then protects your assets. Your assets can then now remain intact for the family to then be able to continue generating that amount of income and that protection that you expected to have. So even if you have that network that you say, no, if I pass away right now, I'm leaving for my family millions, but you're leaving for them that millions in what aspect? So think about it. While still on liquidity and financial protection or financial security, let's talk about Mark. Mark is a middle income earner. He's just started building his assets right now. His total combined assets are probably just approximately 3 times his annual salary. So for Mark, the difference for him, the reason why he needs a life insurance is because if he passes right now, even if the family was to liquidate all the assets that is already accumulated, it's only going to cover them for a maximum of 3 years. So what happens to the family then? So for Mark at this point, taking life insurance is to provide financial security, not liquidity. You're not protecting those assets. You are actually providing financial security for your family so that in any event, they have that money that will enable them to proceed. And you know why we normally talk about 10 times your annual salary? It's simple. When you take 10 times your annual salary and then your family gets that 20 million or 30 million, what happens is even if they invest it in the minimum of 10%, they will be able to get that annual salary of 3 million or that annual salary of 2 million. So that aspect, that capital remains intact while they can replace your income with this annual interest that they get from this money. That is why we talk about 10 times your annual salary. So whatever your annual salary is, even if it comes to 5 million, it simply means then that your annual salary is 500,000. So if their family receives 5 million, they can invest it in a vehicle that gives them 10%, which gives them back that 500,000 that replaces your income. If it's 10 million, then they get the 1 million that replaces your annual income. That is why we talk about 10 times your annual salary. So if you actually want to see how your family or what you need in terms of life insurance, DM me your age and 10 times your annual salary. Then I'll work out for you what it will cost you to take a life insurance to either protect your assets or to provide financial security for your family.